All right, guys. Let me know if you can hear me clearly, please. Let me just get the chat up actually here. All right, Food Do a Lot. I know that you're in here already. Welcome. Good evening. It's 22 of you already. Yes, loud and clear. Right, guys. Thank you so much for coming along. I thought we'd spend a little bit of time, let's do some Q&A, essentially. So, hope everyone's had a good week. I will also, for anybody who does want to join me, have a little conversation, let me just post this. I'll see if I can pin this as well. Let's see if this works or not. Actually, I might need to do it over here instead. 1 second, guys. All right. So let's pin this. Let's pin that. If you want to come on cam, feel free to use that link that I've just pinned to the top right there. But yeah, thought I'd do a Q&A, just have a little conversation, answer some questions, get some engagement, and see where we go from there. So, to be honest, guys, there's a lot going on at the moment in the background, and there's some exciting stuff going on. And I can't wait till we get out of lockdown. Obviously, this should be happening this week. Obviously, we're going to have to wait now until July 19th. But I don't know about you, but I'm really excited to get back out and actually go to work properly, and work on this properly as well, full time now. In terms of content, and a couple of things to ask you guys, I do have some short films coming along very soon. I posted a trailer to one of them midweek this week, which is kind of like a little bit about my background. But I also have one coming out, which will be, it's very, very interesting, and I'm sure it will be fascinating to a lot of people. So the content is going to pivot slightly. I don't want to keep creating videos where I'm just simply talking at you guys. I want to bring other people's opinions into the frame. I want to basically open up that conversation on a wider note. So we're currently in development to a series which will involve you guys, the viewers, members of the public. So, and what we're going to need for that is we're going to need people who want to participate, who want to be on camera, who want to be on the channel. And the idea is we'll put you into groups, we'll put you in a room, and there will be a question or a topic for you to discuss. And we want you to just basically give your honest views and opinions. We're going to capture that. We're going to have some financial education that goes into it as well. And that's what the content on this channel is going to look like. Not every single video. There will still be videos of me just speaking and obviously providing some education and context. But I feel as though bringing in other people's views will kind of let people know that actually oftentimes our train of thoughts are the same. So what I'm going to be looking for is I'm going to be looking for people who are interested to participate. Currently, we are scouting locations. So naturally, I think London will be a good place to start. There is definitely a place in Birmingham that I've scouted today that will be absolutely perfect for this. So if you are the kind of person that watches this, or you're watching this right now live, or you're watching this in replay, and you want to participate, please do drop me a DM on Instagram to let me know. I will need your details, your email address, so that I can take note. And when we're ready to start approaching people and reaching out to people to let you know what the process is going to be, we will camera test people. I've got a whole team to develop this essentially. So once we're ready, then we'll reach out to you guys and let you know what the process is going to be. But if you're interested in taking part in this kind of stuff, being on the channel, having a conversation, and actually, sharing your experience and your feelings and thoughts about financial topics or just life topics, then definitely please message me on IG with your email address and your name, and that you're willing to participate. I'm really excited to bring some of it. Some of the ideas that we have already are proper top notch, but yeah, excited. Right, so let's see what we've got on here. Jidamel, the trailer was cool. Thank you. Yeah, Iki's done a really, really good job with the videography. He did a really, really good job, and I haven't seen the full thing just yet. I've only seen the trailer myself, but he assures me that it's not braggadocious. He assures me that it comes across in the right way, and yeah, if it looks anything like the way the trailer looks, then yeah, I'm going to be very excited to have it all out. But it will probably be another week or two before it's finally ready and stuff. There are some animations that are going into it, and then after that, we've got the second one as well. So I'm excited about that as well. But the second one isn't me; it's actually your. I'm not going to say anything just yet. The second one, I'm very, very excited for. Right, so let's see what we've got here in the chat already. So, guys, this is an opportunity to ask questions. So, okay, Manolis, yeah, good. Yeah, just I've got your email actually. To be fair, so I will note you down. Let me just write you down actually, so we can have a look. Get some people on. All right, okay. So there is one question here that the Angry Ed. Hoping I can kick off with a question. What are your thoughts on emerging market small cap funds when balanced with a developed world fund? They're a good counterweight. They're a good counterbalance. You've got to be careful with emerging markets though, because they're emerging markets. You've got efficient markets and inefficient markets. So emerging markets will be an inefficient market in terms of the reporting and just making sure that the information that is coming out is properly curated and verifiable. Um, the example of that, Chinese don't really like being told what to do. They'll do whatever they feel like, and they don't like submitting to audits and all this kind of stuff. So you need to be careful with that with emerging markets. That isn't to say not to invest in them, but the developed markets are efficient markets because of the checks and the audits and so on and so forth that they submit to. So I won't say you have more security, but you at least know for sure. Well, as best as you can that the information is verifiable, all that kind of stuff, and it's a bit more robust in its audit and check-in. So there's nothing wrong with holding both of them. But yeah, it's all about your risk tolerance, your goals, your investment time horizon, and how you're investing in these markets that matters the most. If you are trying to pick individual stocks in emerging markets, then I would suggest that you're maybe putting yourself at a little bit more risk, because the question will be, can you do better research and better auditing than a professional outfit like, I don't know, Vanguard, for example, or Money Farm or someone like that? You need to be mindful of that. But yeah, emerging markets, there's nothing wrong with them. There's lots of opportunities in emerging markets as well. So yeah, you just need to make sure that you're approaching it with the right risk tolerance and everything as well. So yeah, good question though. I forgot to pop that up on screen. I'll do it on the next one. All right, we've got Ricardo. I'm going to bring you in, Ricardo. One sec. Ricardo, what's going on, man? Can you hear me all right? Are you there? All right, maybe not. Right, let's come back off of this. Let's see what we've got on here as well. So, Karen. All right, let's have a look at this question. Is there any difference in investing in ETFs and index funds for long term? Are index funds supposed to be better for long term growth? Not necessarily. I mean, ETFs are traded essentially, so they give you a bit more transparency when it comes to your pricing. It allows you to exit a little bit quicker and more fluid than an index fund. So there isn't really. I mean, ETFs can be a little bit cheaper as well. So on the cost variance, you could argue that maybe the little bit less that you would pay for an ETF might have a material difference to your overall performance. But a lot of the time, ETFs and how an ETF is built will be very similar to an index fund. So you could argue that maybe there isn't really that much of a difference altogether. But personally, I think that if you're investing over the long term, if you don't need the ability to trade out at any given time, then you may just go for an index fund. But There's subtle differences, but not anything major that I would say would impact you greatly, if that makes any sense. Why do people buy ETFs instead of more diverse OICs, open-ended investment companies, um, OEIC? It really depends. Really, I mean, look, OICs are there. I mean, to be honest, open-ended investment companies are open-ended investments, are open-ended contracts. Same thing with an ETF. You haven't got a period on them. They do have their place, but I think ETFs are kind of more well known in the mainstream, which is why people tend to buy those because they're priced quite cheaply as well for what they basically do, and they're easily accessible. That's from a retail point of view. They're a great engine to use. Yeah, open-ended investment companies you can go and get, but I don't really know of many play offerings or places like Vanguard or Fidelity that will offer you the same range of OICs as you would have on index funds and ETFs. So yeah, on the retail space, index funds and ETFs are just way easier to access. Is it worth putting the odd extra 500 or 1,000 into an index fund as a monthly investor? I currently pay about £200 a month into index funds via an ISA wrapper. Well, as long as you can afford it, mate, that's the most important thing first. If you can afford it, then yes. Make sure obviously you're using your ISA allowance to the maximum amount. So you've got 20k. So if you're only doing £200 a month at the moment, you're only going to use 2,400 over the year. So if you've got an extra, 500 to £1,000 to add on, I'd definitely put that into an ISA, or continue to pay into your ISA. But yeah, if you can afford to put some extra money in, then by all means, absolutely do that. I will do a video midweek. I've been thinking about doing this actually because there's a lot of talk about the whole market crash and the possibility of a market crash and some of the commentary coming out of that. I know I've had a couple of questions on that this week already, so I might provide a little bit of commentary on that this week. But again, it's just also approaching this pragmatically and just knowing that there's nothing you can do to influence whether the market will crash or not, and when the market will crash, if it does crash, and when it does crash. So if you are going to be investing, it's focusing on your goals, not focusing on things that you can't control, like when the market might dip, and using that fear as a crutch not to invest. And I know that's really, really hard to manage, but it's true. But I might provide a little bit of commentary on that this week in one of the videos. Okay, that was my connection. I think I'm back now. Yeah, I'm back now. Okay, cool. Right, where were we? Let's have a look. Mhm. Thanks for this, Taylor. Appreciate it, mate. And good that you listen to the podcast as well. Appreciate you. Thank you. What's my thoughts on precious metals as an investment? Yes, if you're looking at gold and silver, gold in particular is a very good store of value. So a lot of the investment houses will pivot to that when markets tend to drop off. A lot of investment strategies will do exactly the same. So yeah, it's a good store of value. It doesn't mean that they're not going to be volatile though. So even though you're buying, gold, don't expect that your money is going to be consistently safe the entire time, because it may not be. What's going on here? Bear me 1 second, because it may not be necessarily. Okay, my window's just gone blank here. I think you guys can still see me, but I just can't see myself on the feed. Bear me 1 second. I've got some technical issues here. What's going on? Okay, it's just on my side. So let's just carry on. Right, Adam. Adam has asked a question here. So, hi, Pete. What's your thoughts on premium bonds? I feel like no one ever talks about them. It's where I'm keeping my emergency fund whilst the interest rates are so poor. Thanks. Premium bonds are fine. They're okay. They're not bad. people will question whether you get that much value for them. Obviously, you get the draws and stuff where you could potentially win some money. Um, but yeah, they're tax free, they're efficient. I think nobody really talks about them because they're not necessarily a sexy kind of like investment strategy. Really, they're as safe as you can possibly get. You've got no risk to capital whatsoever, and they're just kind of run of the mill. Some people will say boring options to invest in. So there's nothing wrong with them at all, mate. If you've got your emergency fund in there, then that's great. I mean, access to it, getting the money back out is relatively easy. So yeah, there's nothing wrong with them at all, mate. So don't feel as though just because people aren't speaking about them that you can't use them, because they do have a place and they do a job. Is putting a lump sum of money in an overpriced market a good idea, or spread it over 12 months? Okay, so that depends on whether you know what is going to happen to the market. I mean, if you put it into an overpriced market, probably not. It's probably not a great idea. But this is under the assumption that we're going to see a market correction because it is overpriced. And unfortunately, we can't time the market. We don't know what's going to happen to the market. People have been saying that the markets would crash for, the best part of 2-3 years now, and it hasn't. So the argument is that if you try to feed the money in on the monthly basis because you feel the markets are overpriced, and the markets don't then crash over the next 2 to 3 years, have you missed out on growth? Now, some people will say that you have, and some people will be comfortable with that. Others will maybe kick themselves for not taking advantage of just throwing the capital that they have in. We know that from records, if you invest a lump sum, that typically does better over the long term than monthly investments into your investment proposition where you're compound averaging. So the correct answer to this, Karen, is to ask yourself a couple of questions. Do you think the market will crash? If you've invested your money and the market crashes, how would you feel? Would you be okay with it being, that's fine, I can wait and I'll just ride it out? Or would you be kicking yourself thinking, I wish I hadn't invested the full lump sum and just fed the money in on a monthly basis? Depending on your answer, you'll know what to do next, really. I can't give you a direct answer to it because the reality is we don't know what's going to happen in the future. It's time in the market over time in the market. And we know that lump sum investments typically do better over the long term than monthly payments into an investment portfolio. But it is down to what you're comfortable doing, bearing in mind that you're going to have to carry the investment risk for it as well. Let's have a look at this one from Kevin. Pete, I saw an ad that says I could invest in a prestigious wine and I could get 10 to 12% return per year. Is that true? Or is it just fake news? There are some wine opportunities that you can invest in. Yes, there are. You need to do your research before you go and put money into those kind of things. There are all kinds of clauses and stipulations around the terms and conditions. Some of them are legit. Some of them are complete and utter farces. So if you don't know anything about that industry, stay away from it. If it's something that you know about, then by all means you can. But I generally say to people that, if you don't know about something, don't be attracted by 10%, 12% return. Okay. That's what people who went into water mining go into all these Ponzi schemes. That's what they're chasing. They're chasing the return. They're chasing the high return, not really understanding what they're going into. So you need to make sure you really understand, you read their contract, you do the research on their company to make sure that they're a legitimate company. There are a lot of them that are out right now that are illegitimate, to say the least. So you just want to make sure that if you're going to put your money with this kind of stuff, that you know what you're doing. There are some legitimate ones out there, but there's a lot of just cowboys as well in that wine space. Jadamel, okay. Pete, aside from cash, what would you say is the most liquid physical asset? Um, the most liquid physical asset. So we're looking at speed of liquidation here. Stocks will probably be the next one after cash, really, because you can sell it relatively quickly. You can sell it on a day, get the money, out in maybe 3 to 4, 5 days max. So stocks will probably be the next thing, which is why you have this age-old argument over um, property and stocks. Property is great, don't get me wrong, but it's very, very illiquid, very, very tax inefficient as well. Where with stocks, you can put in your sell order, it's sold, you get your money back relatively quickly. It's nice and easy, and that will be my second most liquid asset. So this is an interesting comment. Avoid emerging. US about to legislate against investing in 59 companies due to military links. Yeah, I mean, look, if you're going to invest in emerging markets, I mean, I think there's a bigger danger in here around some of the Americans about to pass a law where they will potentially take some of the Chinese company off the US exchanges. So again, you've got to do your research when you're investing into that region. You really, really do. Um, I would, I would argue that the better thing to do would be, if you want exposure to the emerging markets, do it via a robo investor. Do it via Vanguard, Fidelity, Money Farm, Moneybox. Do it via someone like that. Trust me, they use the leverage of the money that they have behind them to make sure that they can do as thorough research as possible. You as a retail investor will never have access to that kind of infrastructure and information that they will get. You just won't. You won't even know where to look. Whereas these guys have floors and floors of people. So if you're going to be looking at investing in emerging markets, make sure that you're using a robo investor or using an expertise to help you access that, because there is so much you could get wrong, particularly in that sector or that region of the world as a retail investor that's doing it on your own. Let's see. I'm going to see. 1 second. There's a question about Michelin star restaurants. I don't eat in many Michelin star restaurants, not at all. Let's bring Manolis in here. 1 sec. Hey, dude, how you doing?
I'm very well. How are you?
I'm not bad, mate. Not bad at all. I can't see my video at all for some reason within the streaming platform, but I do see it on the side here. So, yeah,
Yeah,
man.
we can see you then. So,
Yeah,
but yeah, so that's fine.
good.
Two things. First, I saw the question earlier about wine investing.
Hmm.
A friend of mine was looking at something similar with whiskey, and after I checked the company on Company's House, I saw that the company that he was looking at had changed names a couple of times, and it had a patchy history.
Yeah,
So be extra careful with that. I'm
yeah.
not saying that the wine company is not legit, the one that the your viewers saw, but be extra careful. Just
Hmm.
yeah. Um, Now to my question, I had found some small cap companies in the UK that I wanted to invest in, but they are in the AIM exchange, not the
Hmm.
standard London Stock Exchange.
Yeah.
Um, I couldn't access them through free trade. They're for the Plus members only.
Hmm.
So I could access them through the Giro or Fineco.
Hmm.
But my question is, are there additional risks involved at the AIM stock exchange?
Yes and no. I mean, some of the companies that are in the AIM market are big companies. If you look at the UK, like ASOS, they're huge. I mean, what have ASOS just done? They've just bought out. They bought a massive one of the ones that have just closed down. I can't remember, it's Debenhams or something like that. So there are big companies within the AIM market itself. So you have the top tier, if you will, of the AIM market. When you're going down lower, then you probably need to be a little bit careful.
Mhm.
Naturally, that market will carry a bit more risk because they are, generally speaking, newer companies that have only just really started, who have maybe just a little bit of trading history. We would use them in the industry when I was working for an investment house, we would use them for things like business property relief, because the government actually gives incentives for people who actually invest in those kind of companies. So we would use them for those purposes specifically. And the business property relief and the benefits that you get within that scheme actually outweighs some of it, helps you offset the risk that you're taking by investing in some of the companies in the AIM listing. So if you are going to do that, what I would suggest you do is have a look at all of the AIM companies and try and have a look at a section of them that are in the top tier of the AIM classification. Those will probably be the bigger companies that have more capital behind them. They've been running around for the longest, and they're probably turning over the most in terms of profit. If you're looking at some really small cap ones in the AIM market, just know that you're taking on additional risk. They could disappear. They could disappear quite easily if they don't perform in terms of their numbers. But there are some good companies in there still.
Okay. Okay. Cool. Thank
Cool,
you.
man. But yeah, AIM is. I need to do something on AIM specifically. It's an interesting conversation when you look at AIM, and it's not a market that a lot of people are kind of aware of, because we obviously, focus on the FTSE 100, and all of those, like the FTSE 250. But the AIM market
Yeah.
is there.
Yeah. I mean, I was looking at some graphene and nanomaterial companies, which
Hmm.
I mean, I think it's gonna be huge in a few years, but at the moment they are penny stocks. I mean, one I'm looking at the price now is 0.07
Hmm.
pounds, so it's risky, obviously, but hey,
Yeah, I mean, when I was in Canary Wharf, and this is back in 2013, 14, we there is a massive advisory network here in the UK. They're based in London, actually. They have a graphene fund. There was so much money that went into that. So much money went into their graphene fund because it was supposed to be the future.
mm,
And whilst the applications for graphene are numerous, there doesn't seem to have been that breakthrough to really push it through. Whether that's coming
yeah,
down the track, we don't know.
yeah,
But yeah, it's just been one of those ones where it will be coming up 10 years since that fund actually launched. They had so much money go into it, but nothing's really happened
mm,
with graphene as a application tool at this point.
okay, all right,
Cool, man.
thank you.
Appreciate it. All right, guys. Let's see where we are. I've got I've got this question here. Palantir. I don't follow Palantir, mate, so I can't really give you a view on Palantir, if I'm honest, Stuart. Um, People ask me on that. I should really have a look at it, but it's just not one. It's not a stock that I actually follow myself. It's not one that I actually own either. So it's not one that I can give a commentary on at this point. All right. So this is a question from Ricardo. Where's the best place to start in? I think you mean trading there. Um, App wise, there are lots of them that are available for you to use for trading. eToro pops to mind because they actually have the features that you would need to actually trade properly, and the speed of the execution is actually pretty quick as well. So eToro will be one. I did a review on Comex Pro. Um, they are similar to eToro. There's a video on that. You can go and check it. I think it was 2 weeks ago. It's called. It's got a thumbnail, and on thumbnail it's got trading platform. So go check that one out. Their execution speed is quicker than eToro's apparently, and I think they were giving away. What were they giving away? They were giving away 20% off all of their trading fees for a lifetime, and when you signed up, you got I think it was like a sign up bonus of either between $100 and $1,000, depending on how much you deposited to get you going. So Comex Pro, eToro. Where else would I say? Fineco is a good one as well. Fineco's got awesome tools for trading. I mean, better than Comex Pro and eToro. There's a lot of functionality with Fineco Bank with that as well. I've got a video on them too. Who else? Those are the three that come to my head right now. If you're looking to start trading, I mean, obviously it is a massive learning curve. So make sure that obviously you know what you're doing But please just be mindful of that. It's going to be a big learning curve to actually get going. Here's a follow-up on this. Nervous about committing to index funds. Any reason not to load up my stocks and shares ISA with cash to maximize allowance until I feel the right time to invest? Well, okay, so if you're in a stocks and shares ISA and if you're in a stocks and shares ISA and it's invested, depending on how assuming you've not picked all of the stocks yourself, then you're already investing in a version of an index fund. Because if you use Moneybox, Money Farm, or any of the robo advisors, Nutmeg, Wealthify, anyone like that, they basically bought an index fund or an ETF for you on your behalf. So inadvertently, if that's how you've invested your stocks and shares ISA, you're already an index fund. So there's nothing really to be nervous about. You're already in one. So just bear that in mind. But if you're thinking about having your stocks and shares ISA and then a separate index fund on the side, that doesn't make any sense if you haven't maxed out your stocks and shares ISA. So I would do that first, because tax efficiency first. That is the rule. That is the primary goal, tax efficiency first. So I hope that helps. Yeah, there's a question on, you know what? The email came through. When did it come through? I think it was on Friday, but I was in London. I've not had a read through it just yet. I need to have a look through it. Yeah, I think on that last bit of the question, I'm pretty sure that all of them do that. Robinhood definitely do that. Do they? I'm pretty sure they do. There are certain things that they cannot do in the UK, though, which is why Robinhood didn't end up coming here in the first place. Because one of the big ways that Robinhood monetized the platform in the States is by doing something very, very similar. And it's not allowed here in the UK. Now, Trading 212, I've just updated the T's and C's, that I'm sure is not what Robinhood were looking to do, but I know that they can lend out your stocks for hedge funds to basically short. That's going to be a way for them to monetize the platform. After all, it is free for retail investors to use. So now what they're essentially doing is, now that they've got the scale and the scope and the money under management, imagine that. That's going to be a big, big money maker for them. So yeah, I'm sure other platforms will do that as well, but I just don't know which ones. But most of them will do that if it's standard. A lot of it is standard practice. Is it worth trying to develop a dividend portfolio to eventually pay you as a monthly passive income to live off? Yeah, absolutely. I pause on this because straight off the bat, I will be questioning why you want a dividend portfolio for passive income, and I'll be questioning when you actually need it for. Okay, so you talking in the near future or in the long-term future? Because that's what your pension is for. Your pension is there to help you generate monthly income so that you can live off that. That's the whole point of having a pension. If you're thinking of this in the short to medium terms, 10 to 15 years, then yeah, absolutely, because you won't have access to your pension till you're 57. So if you want something prior to that, then by all means, yes. I just think that, the whole idea of building a dividend portfolio for passive income, I think it just robs you of the benefit of time and compound interest. And I would question, if we were doing coaching, I would question why that's important to you, whether it is actually important to you, or whether it's something that you want to do because there's a lot of videos on YouTube talking about passive income and what it can actually do. Because, like I said, I personally believe that going after dividend portfolios specifically robs you of time compounding, and it also robs you of the ability to participate in some really great companies that are not paying dividends. Amazon, Tesla, right? It robs you of the opportunity to have access to those because you've got that filter that they have to be paying dividends. And, in order for you to generate a monthly passive income that you can live off, let's not beat about the bush here. You need a substantial amount of capital. A substantial amount of capital. So this is a conversation we can have all evening. I think the conversation around passive, dividend portfolios and passive income, I think it's very, very social media driven. And whilst it's sexy and it's got a lot of attractive qualities to it, you have to think about the practicalities of how you're actually going to go about doing it. Because if you don't have the capital, you have to work to get the capital. Then the earlier you start and the more income streams that you have to have a plan specifically for that. So those are just my views, and people may or may not agree with that. I like this. Actually, let's have a look at this. There's 77. There's 24 likes right now. All right, so I love this. You do this every time, mate. I appreciate this. So please do smash that like button. By the way, let's get this up to 40 if we can. We just need another 16 on that like button. Um, This is a good one. Saving £1,000 a month a reasonable amount? Yes, it absolutely is. There's not that many people who can afford to save £1,000 a month. So if that's your starting point or where you're going to end up at, that's really, really, really good. Again, just make sure that it's something that you can afford to do. And if you're having to cut corners and tighten your belt in order to do so, make sure that you're happy that you're doing that as well. These kind of things should never be like a chore, or too painful. So just be mindful of that, because I think really, really important. You have to kind of have balance within all of this as well. Varun, for free trade, is there a required margin to keep the account open? Do they close the account if your account value is negative? You can't go into a negative account value with free trade. That was virtually impossible because it's not a trading app. So if you don't have any money in there, it will go to zero. I don't know that they have a required margin. You'd have to speak to the team over there, but you can't go into a negative balance with free trade. It's not a trading app. Martin, hi Pete. I got investment trust Templeton emerging market. It's basically for every one share I own, they will give me 5 new ones. Management want to dilute the shares from around £10 now to around £5. Okay. I've not heard of that. I don't know. I don't know whether there's a question within there. What's the reason for diluting the shares? Do you actually know? Is there anything that you can provide on that? I mean, it may be a question that you need to ask of Templeton. I mean, I'm sure in order for them to be able to do that, they would have sent you some literature and stuff with a little bit of rationale as to what's going on. So I would probably suggest that you speak with them and just make sure that you read whatever literature they've sent you to try and explain what's actually happening. As long as you're not financially worse off, which I don't think you would be, that's the most important thing. I've just seen in here, New Orleans checking in. Kev 504. If you're in New Orleans right now, thank you for dialing in from across the pond. That's amazing. That's really, really cool. You're 25, you're saying as well. Good man. Or you're number 25. I don't know if that's your age or that's your number you're saying on there. I'm sure that you're saying that's your age. Is it possible to stop losses on Vanguard funds? No, it's not, because it's an investment. It's not a trading account. They invest it. It's a passive investment a lot of the time, so you can't put stop losses on those. No. I've got this one, Fujiwala. What was your question? Type it back in here. I haven't seen it. Let me just go back. I don't know whether, because I'm going through them sequentially as they're coming through, and I haven't seen another one apart from your top comment at the very, very beginning. So pop it back in here again, Fujiwala, and I'll see what I can do. If it pops in at the bottom, I will get to it as well. I just need to find where I was. Where were we? Bear with me, guys. I think I'm almost caught up. Almost caught up. Yeah, there we are. Question is second in the comment section. All right, let me just go scroll up on here. I can see loud and clear. Thank you for your time. We appreciate. No, I haven't got anything else on there. Let me know. Just ping it in here again, mate. Fabia. Okay, let's have a look at this one. For how long, ideally, should one invest in ETFs monthly to start with? For how long, ideally, should one invest in ETFs monthly to start with? I'm not sure I understand this question. How long, ideally, should one invest in ETFs monthly to start with? Are you talking about monthly contributions? Or are you looking at investing overall? Maybe give me a little bit of clarity there, because I can't make sense of that question. Okay, so this is from John. I can afford to invest £1,000 a month. Is that too much, or the more the better over the long term portfolio? Mate, the more the better. The more the better, because the difference between investing £1,000 a month and investing 200 quid is absolutely huge, especially when you start thinking about the compound interest effect that you're going to get. I mean, it will be worlds and worlds apart, mate. Massively so. I don't know. Hang on, let me just see if I can just show you guys something. 1 second. Let's use this one right here. All right, you guys should be able to see this. Okay, let me see if I can get this a little bit bigger. Okay. So let's just say you had a zero deposit to start off with, and let's just get this in pounds. And let's just do an average, I don't know, 10% per year roughly. You do 20 odd years here. You compound this on the monthly basis. And let's just say you're doing 1,000 a month. Okay. If you get a 10% return on average every single year, let me just hide your comment very quickly so you can see this properly. That's how much you're potentially aiming at. 718,000, right? So if you go up and change this to 200, 143,000. So look, you're looking at a difference of, almost just under 600,000. It's £500,000. So the more you invest, the more you're able to put in, the better over the long term, because the compound interest effect is absolutely huge. So, if you can afford to put in £1,000, throw in £1,000 and just stick with it, and just, compound interest, pound cost average all the way over, you're going to thank yourself. I mean, £718,000 in 20 years is a pretty decent return. And again, obviously, we don't know what's going to happen with the markets. You may not be able to get 10% on average, but that's what you could have. If you are lucky enough to do 11, 12% per year on average, then you're absolutely laughing. But the more you can invest, the better it's going to be for you. Hey Pete, I asked a question. What are your thoughts on investing past the 85k mark? There's no reason why you shouldn't. Yes, you've got financial services compensation scheme up to £85,000, but that shouldn't be a preventative measure to stop you from investing with people. There are some providers that will extend the 85,000 compensation scheme limit so that they'll give you unlimited cover. So if they go bust, if you've got 200k, then you're going to get 200k. PensionBee is one of those companies. So you can watch that out. You can watch out for that when you're doing your due diligence, because that, if that's important to you, then obviously you should try and see if you can find providers that offer you that unlimited protection. But for the most part, most of them are £85,000. It may mean that you then, put £85,000 with, I don't know, Money Farm, £85,000 with Eureka, £85,000 with, a number of providers to make sure that you feel comfortable in that. But it shouldn't be something that you use to prevent you from investing. Hex King, what's going on? How you doing? This is a good one. Ali, any advice to someone who's 18, learning to invest or do trading and getting other forms of extra income? Thanks. Be careful. Be careful first and foremost. Try and pick your sources carefully. Try and be smart about it. Try to resist FOMO where you can. There's a lot of stuff out here at the minute that will tell you that if you're not doing this, you're not doing that, then you're making a huge mistake, that you're a loser, that you're missing a trick. They'll try to use a lot of psychological tricks to get you to either put money with them or to start trading with them. Please, please, please be careful. Make sure you do your due diligence. Like really, really do your due diligence. If it sounds too good to be true, then it probably is. Follow your gut. If your gut is telling you something's not right, do not allow yourself to be persuaded. But in terms of the education piece, try and make sure that you soak up as much information as possible. Again, make sure you're trying to vet your sources, so you're not just listening to any old Joe blogs. But try and make sure you get a good grounding of how things work, and do your due diligence. That's the most important thing. In terms of extra forms of income, I would not rely or look to investing or trading exclusively for an extra form of income. This is a big mistake that people make, particularly when you start talking about trading. And this is the fallacy and the lie and the BS that social media has sold everyone, that you can start trading today and you'll be making income tomorrow. That's not how the world works. In order for you to be able to be trading and get a regular income from trading, that takes years of practice and years of perfecting your trading style and perfecting a trading system. It does not come overnight. I don't care who you're listening to, who you're watching on YouTube, on Instagram. If they're telling you that, they're fucking lying. Tell you that point blank right now. They are lying their asses off. So don't look towards investing or trading as an additional source of income if you're just starting out. Don't even bother. The best thing that you could possibly do is start your own side hustle. If there's something that you're good at, copywriting, photography, videography, whatever, Amazon FBA, go and actually start a proper side hustle. Do not look to investing or trading exclusively for an additional income. It does not come overnight. I don't care what anybody tells you. You need capital. You need capital and a lot of know-how and a lot of practice to make it work. So please don't be sold the dream of digital nomad, people trading, sipping Mai Tai, sitting on the beach. That may be the reality for them, but you don't know their backstory. You don't know the work that they put behind it. A lot of these guys who are selling trading courses and, all these freaking signals, they're making more money from their courses than actually trading themselves anyway. So just please be careful. Don't be roped into any of the nonsense. That's what I would say. I get very, very passionate about this kind of stuff. It really annoys me when I see people roped into this narrative of, I started trading 3 months ago. I'm making this much. Fuck with. I've got to watch my language, but please just be careful. Am I doing any more on CFX soon? There isn't anything that I've come across that really warrants one right now. I've had a couple of to be fair, I had a very respectful conversation with one of their like ambassadors or advocates or something like that. It was a nice conversation. I put my point across in terms of like, there's a ton of stuff you guys are doing wrong. It gave me an insight into what they're actually doing. I still don't agree with it. In fact, I think it's even more chaotic now that I know how it operates, with just so many teams globally that have no central direction whatsoever. Like literally, you can set up your own team and do whatever you want. It's dangerous to say the least. But the conversation with that lady was very, very respectful. She's a nice lady. She genuinely believes in what she's doing, which is fine. I just completely disagree. And there was another person who's just an absolute, I can't even say the word. He's a hooligan, basically, thinking he can come onto my platform and spout some abuse. He wouldn't even agree to just simple like terms. Like, we'll speak to each other like human beings, we'll be respectful, and if we disagree, we'll agree to disagree and go our separate ways. It just shows you the kind of people that they're dealing with. But I haven't got anything planned for them, unless something big were to happen or a big piece of news were to break that I think would be worthwhile people knowing. What's your advice on dozen banks, 5% bond, which they offer? I don't know because I've not looked at it, James. But if it is a bond, if it's a bank bond at 5%, I think 5%. Let's have a look. One sec. Dozens Bank. I'd want to know what bond they're offering. It looks like it's a corporate bond. And it looks like it's a self-issued corporate bond. Yeah, I mean, I think this is a self-issued corporate bond. So it's a bond with dozens themselves. So you're lending the bank your money in exchange for a 5% return. It looks pretty attractive. I don't have the time to do this right now live. But what I would be doing is I'll be doing a little bit more research, James, on dozens themselves. If you can, I mean, where are they based? I don't know. It doesn't give you much on here, but we can see FCA and all that kind of stuff. That's fine. They are registered. So, but this won't be covered under the Financial Service Compensation Scheme. I'll do a little bit more research on them themselves. I'd have a look and have a little glimpse, a little look into maybe their financial accounts, just to see where they are from a financial footing, their balance sheet, what their assets and liabilities are. I would check that out first. But it sounds like to me this is a self-issued bond where you're lending Dozens Bank money in exchange for a 5% coupon. People, I would say that that's pretty generous in this current climate. It really, really is. But just make sure you do due diligence on Dozens themselves before you go and jump into this, just to be sure. But yeah. I'm just trying to decide. I'm just trying to decipher whether this is a conversation, whether I should be paying attention to this, whether there's a question in there. So bear me 1 second. So James has just said here, I recently had around £700 refunded to me by HSBC, which I used to pay off credit cards. Why have they refunded the money? So, I mean, this kind of stuff doesn't fall on my radar at all because I don't bank with HSBC. So, unless it's in the news, I'm not going to know about it. But why have they refunded the money? Is it from something in particular? I don't know. Good question here. Is this a time for value stocks such as FYS? I mean, value stocks are always going to be stocks that the smart money, as they call it, will always flock to because these are companies that have been around for a very long time. So there will always be money that will sit within value stocks. When markets are rocky, money goes to value stocks potentially. Well, most of the time. So yeah, FYS maybe a good area. I think in any portfolio you need to have some value stocks in there anyway because they give you a bit of stability. I thought about buying some gold bullion coins while the price for gold has dropped. as a long-term investment, 20 years, good or bad idea? Bad idea. I mean, it could be a good idea. You just need to think about how you're actually going to. So when you're buying these gold bullion coins, they're going to have a premium to it anyway, regardless of the price dropping. So you will not get that bullion coin at the market price. You're getting it from somewhere, so it's going to be a markup. You then got to think about how you're going to dispose of it as well, which is, some of the issues when you're trying to invest in gold. Yes, people like to have physical gold, but there are more liquid, quicker, easier ways for you to invest in gold to hold. But I completely get the point of actually having gold actual coins available to you, but you're going to have markup. You're not going to get it at market value. You're going to have markup, so you need to account for that as well. But yeah, holding it for 20 years, still a good thing. So look at this. Is this the moment for UK bias in value stocks given high inflation and interest rate risk? Is this the moment for UK bias in value stocks? I mean, from a global point of view, I think we're probably, well, actually, we're not further ahead than other countries when it comes to the whole COVID thing. I mean, if you look at some of the GDP numbers, we're bottom of the list in terms of performance. Period. I mean, Turkey's done better than us. I was looking at some numbers last week, and Turkey's second in terms of like GDP numbers and performance, just generally in terms of the economy out of COVID. Turkey is second. We're bottom of the pile. So from that point of view, really, really bad. But having said that, in terms of vaccinations, we vaccinated the most per capita. We seem to be in the pipeline to have the ability to come out of lockdown a lot quicker. So with that will come confidence in some of the companies and stocks in the UK market. So potentially, depending what happens, if we do get freedoms on July 19th, then you would see airline definitely. And those recovery stocks definitely increase. Value, yes, I think so as well. But yeah, inflation and interest rate risk. Look, our inflation numbers are nowhere near as bad as the States. Our inflation number is 2.1. It's 0.1% higher than the Bank of England base rate. The fear is that the inflation will go up to 2.5 by the end of the year, but fall back in line shortly after that. So I think even if you have, the inflation rates go up to 2.5%, you may then get the guys at Bank of England and the Monetary Policy Committee talk about increasing interest rates, but we're going to know about that beforehand. So, and interest rates increasing isn't necessarily a bad thing. It might stimulate the economy a little bit and pump some more money into the system. So, yeah, it's an interesting conversation piece, that though. Sean, let's have a look at this. If you buy a house in the next year, would you withdraw your investing money into a stocks and shares lifetime ISA? Would you withdraw from investing money in a stocks and shares lifetime ISA? If you're within 12 months, then you wouldn't want it exposed to the markets if you need that money within that short period of time. So if you can't get it into proper, actually, you know what? Because you're looking at 12 months, you're probably better off going into a cash lifetime ISA. Because if anything happens in the next 12 months where the market's basically dipped 2, 3, 4, 5%, that's going to be a hit to your deposit. So if with 12 months to go, mate, cash lifetime ISA is probably the best thing for you to be in, because you're still going to get the bonus from the government, and hopefully you've made a little bit of money whilst it's been invested anyway right now. So I would be protecting your position now, and just put it into a cash lifetime ISA. You're going to get the help from the government. Hopefully you made a little bit of money by it being invested, but just don't get greedy. Remember, the goal here is to buy a property. It's not to make a load of money on the stock market. It's to buy a property. So as long as you're ahead, that's the most important thing. Okay, this is a good one. This is a mortgage related one. So I've just cleared my IVA early. Was January 2022. What are my chances of a mortgage in May 2022? Um, the first thing you need to do is make sure that that IVA is off your credit report. Some of the lenders will have a criteria where you cannot have an IVA within, I think it's 12 months from memory. It may be a little bit longer, but I think 12 months sticks out to me. So you need to do a lot of work, Courtney, on your credit report. So if you're not monitoring your credit report right now, you need to be downloading ClearScore, number one. You need to be looking at your Experian credit report, and you also need to download Credit Karma. So ClearScore is free, Credit Karma is free, and you can access Experian free as well. You want to don't pay attention to the number, like, because for example, ClearScore will score you up 700, and you might be, I don't know, 400. Pay no attention to that number. With Experian, it's 999 that they score you out of. You could be at 800. I don't care what that number is. Do not pay attention to that number. You actually want to see what's on your file. So you want to have a look at what's on your file. The lenders are going to look at what's on your file. You want to make sure that your IVA is noted as satisfied, and you just want to be clear whether it's 12 months, 24 months gap between you paying off your IVA. You want to make sure you've got all your ducks in a row there. So it's work on your credit report. That should be your very, very next priority. I'm just looking at time. We've been over an hour, so I know that we've got quite a lot here still. So I'll try and get through as many as I can. Okay, let's have a look at this one. Okay, holding a personal pension for 30 years plus better than holding a self-made portfolio for 30 years. Yes and no. It really depends. You can't equate your personal pension to uh, a self-made portfolio, a general investment portfolio, an ISA portfolio. Their jobs are very, very different. They're not built to do the same thing. Within your pension, you're going to get a lot of money free. You're not going to get that within your self-made portfolio, your general investment account. So there are different roles. So again, this is why you have to be very, very clear what you're investing for. Like, why? What's the purpose here? If it's to retire early, okay, what does early mean? Is that 40? Is that 50? Is that 60? If it's 60, pension. If it's 40, general investment account, offshore bonds. Those kind of things come into the equation. So you need to know what you're doing first in order to be able to go to the option. This is what a lot of people do, right? They'll watch a load of stuff or come across a load of stuff online and think, right, I'm going to take that off the shelf. It may not be the best thing for you because it's not built for what you want. So again, I talk about this all the time. You have to be clear on what you're investing for. Once you know what you're investing for, then you can go and pick out the appropriate thing off the shelf. I've just mentioned offshore bonds there. I've not spoken about offshore bonds on the channel purposely because offshore bonds aren't for everybody. They do a very specific job, and you have to be within a certain criteria to make the full use of those things. So, you need to be clear on what you're doing at the first place, and then a pension or a general investment account or a self-made portfolio will come into their own based on your goal. Would you say it's reasonable to have a portfolio of 75% developed world, 12.5 small cap, and 12.5 emerging market? So if this is too specific, my time horizon is long and I'm risky-ish investor. I need to know your exact risk profile, mate, because that does sound completely reasonable. But the thing is, mate, you're talking all equities here. So that's a 100% equity. So even if you are a risky-ish investor, what does risky-ish mean? So risky-ish, if you're scoring on a scale of 1 to 10, risky-ish will be 7 to a 10. But are you a 7? Are you an 8? Are you a 9? Or are you a 10? You've got a 100% equity portfolio there. So essentially, in football analogy, you've got all attackers on the field of play. You've got no defense, really no midfield. So how are you going to defend yourself from the threat from the other side? That's just an analogy, just to bring this into context. So it's really, really hard for me to say, yeah, that's completely fine, because I don't know where you are. I don't know if you're 7, an 8, or a 9, or a 10. There's the kind of stuff that I go through with people in coaching, because you're not using any other asset class here. That's pure equities, which is high risk. So with that being a high risk strategy, 100% equities, if you are 7 out of 10, you're taking way too much risk as it is. So there's a lot of considerations there, and I don't know your personal circumstances well enough to be able to say, right, maybe these are a couple of things, bear in mind. But again, that's the kind of stuff I would do with people in coaching, to kind of give maybe a little bit more of a clearer picture, because I can ask questions about what your goals are, what your situations are, how your finances are actually lined up in context to your investment strategy. Then I can give you actual pointers to say, right, okay, these are the risks here. You might be a little bit overexposed if you do this. These are the reasons why. But without knowing your details, it's very, very hard for me to be able to comment. Yeah, there's a question on here, infinity protection. Some of them offer them, some of them don't. So you just need to make sure that you're doing your research. They have a certain clause, phrase that they use. They will say they offer unlimited protection under the Financial Services Compensation Scheme. There's not that many of them that do it. Pension B do it. There's some others that do it, but there's not that many of them that do it. What's this? This is an NFT question. I have a NFT coin. What can I do with them new to this? Mate, NFTs are not my area of expertise, mate. So I wouldn't know. I wouldn't know, mate. I would not know. I mean, there's a load of resale sites that you can obviously list it if you want to get rid of it or so. But I don't know what it is that you've actually got, so I can't really comment. How do you best understand fees when opening an ISA? I've been waiting to open an ISA for months, but the monthly fees when buying shares, it stops me. Okay, so that depends on who you're using. So I guess that you're trying to buy individual shares yourself. The fees are the fees. If you want to go down that route, you've got to pay the fees. The only thing I would say is they will have to provide you kind of like, a lot of them will have like, this is your fee, then a question mark. Click on that question mark, it will give you an explanation of what the fee basically means. But if you're buying individual stocks, depending on who you're using, you're going to have a fee. If you're using like a robo investor, then they will have to break down all of the fees that you have to pay, and they will provide an explanation of them all. You have to read what they all mean, though. Because there are different, there's annual management charges, there's investment manager charges, there's a whole host of charges. You have to understand exactly what they basically mean. And a lot of them will display them differently as well. So depending on the provider that you're using, just try and seek out as much information. It will be on things like the Key Investors Information document, the KID. You'll have all of that in there and explain and list all of the charges. Whether you invest monthly to have compound interest, Vanguard, Life Strategy Funds, ETFs, or HL, anywhere that you invest where you're putting money on a monthly basis will give you that compound interest effect. Good question on here. When are you going to show us your portfolio? I don't show my portfolio for a very specific reason. People on YouTube will show their portfolio, and then they will have people who will go and copy them. I do not do what I do so that people copy what I do, because my approach is my approach. It works for me. I have my own financial setup. I have an emergency fund. I've got money in the bank. I've got my own investment strategy. Your circumstance is very, very different. So my approach, if people want to copy, and I know that this happens a lot of the times, that's why I don't do portfolio updates, is because when The markets are great. It's a great doing a portfolio update, but when the market has been really, really bad recently, how many YouTubers are doing their portfolio updates now? Not a lot, because they don't have a lot to sing about. It's it's okay to show my portfolio and say, like, oh, this is how much I've got and blah, 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 and this is my performance and stuff. But what does that actually mean for you? It doesn't mean anything. You shouldn't be copying my strategy, because my strategy is my strategy. The principles behind the reasons why I invest in a particular way are relevant, which is what I'm trying to show. But I don't ever show my portfolio ever. I think at the top of the year, I did one where I talked about, did I lose money last year in 2020? Because I thought that was a really important lesson within that, in the fact that I didn't lose money despite the market crashing, despite us being in lockdown. But this YouTube channel is not about sharing my portfolio and telling you how great I am in terms of what returns I'm getting. I don't see any benefit to the viewers in seeing that. I don't know. Tell me if I'm wrong, or tell me if it's something you do actually want to see, but I just don't see the benefit in it. And there's a lot of people doing portfolio reviews, and I just don't see the point in it. I just think it's disingenuous to a certain extent, because when things are bad, they don't do those reviews. So it makes no sense to me. Viraj is just saying there, thank you so much, Viraj. Yeah, hopefully in the education piece at some point. That's something that is being worked on right now. I'm just literally just going through the comments on here. There's another one on here about Dozens Bank. It was just a conversation of here. 20 years, I'll check their balance sheet. So if what you're saying there is that they've got a CEO that was with HSBC for 20 years, that, tracking someone like that is important, because it means that actually it's being run and helmed by someone who's got an industry experience. That is very, very important. So those are all key things that are worthwhile noting. But that bond looks like a self-issued bond. So yeah, they would have to be pulling in quite a bit of profit. Ideally, they need to have a good balance sheet, really, for that to be honored. So the balance sheet is going to be important. This is a question. Did you get any hate for doing GB News? Thoughts on? Thought you were great, by the way. Cheers for that, Shrek. Well, not yet at the moment. People have been like, oh, why have you gone onto it and stuff like that? And it's like, well, first and foremost, I got approached to do it, and it's commenting on financial kind of like news and maybe some of the current affairs and stuff. I think there's a lot of stuff around here being very, very right wing. I've not personally seen that just yet, but I don't sit there and watch TV all of the time. But I think even if you do have an element, for what I've read, they want to be able to have a conversation on both sides. So that's okay. If they've got right wing views, I'm completely happy with them to spout everything that they want to spout on that side, as long as, if I'm asked a question, I'm able to give the counter argument to that. Because if they really want to have a conversation, you need both sides of that story. And in having that conversation, that's where you meet in the middle. So I think that's where my job is going to be. But for the breakfast show, for example, I'm giving a little bit of commentary on some of the business or financial news of the day. It's a 10-minute segment. I don't really have any influence on the programming or anything like that. It may be something I do on a regular basis. I don't know yet. We'll see. But yeah, but I've not had any hate on it just yet. I've had a few people like, I'm surprised you won on this. I'm like, well, I don't know why, but it's not going to impact my own personal principles or anything like that. So let's have a look. All right. Okay, cool. I'm just conscious of time, an hour 15. I know that there's still a few in here, but not going to get to them today. Yeah, guys, appreciate you for coming on. I do. I think I'm going to call it a night in here. Got a busy week ahead. So yeah, just watch out. New videos will be out on Tuesday. I've got to sort out my schedule and what I'm doing in terms of 2 videos a week. Hopefully, the short film will be available maybe on Friday. If not, it will be next week when it's available. Guys, I appreciate you. Have a good evening, whatever it is that you do. Cheers.